If you are 55 to 65, have under $200,000 in your RRSP, and you have ever felt like the government built a trap to take back your own savings, you are not imagining it. This is the shape of the trap. The Canada Revenue Agency lets your RRSP grow untaxed for decades, then forces you to start pulling it out by age 71, whether you need the money that year or not. Stack that forced withdrawal on top of your CPP and your income can cross $93,454. Above that line, the old age security clawback takes 15 cents of every extra dollar. Left alone, that combination can cost the average near retiree $50,000 or more in taxes and lost benefits over a decade. That part of what you already believe is accurate. It is missing one variable, though, a rule inside Section 146.3 of the Income Tax Act that lets you convert your RRSP on your own terms instead of the government's. Almost nobody uses it because it takes a bit more paperwork than doing nothing. Used the right way, that one rule does not just shrink your tax bill. It is the difference between guessing at your retirement spending every year and knowing exactly what is coming in. I am going to walk you through exactly how it works with real numbers in this video. If you have ever felt like the RRSP was built to punish regular Canadians instead of reward them, that is exactly why this channel exists. Subscribe, because we dig up the rules that protect people like you, not just the wealthy. Take Mark and Lisa. They are 63 and 61, married, living in Ontario, and between them they have $180,000 sitting in RRSPs. If they follow the standard advice and leave it alone, the math turns against them fast. By 71, the government forces minimum withdrawals from their RRIFs, whether they want the income that year or not. Combined with their CPP, that pushes their total income past the point where old age security starts shrinking. Together they lose roughly $8,000 a year in clawed back OAS, and their effective tax rate climbs from around 12% to close to 28%. Here is the piece nobody tells them. That entire meltdown strategy you hear about, the one where you draw down your RRSP aggressively in your 60s, gets written for people with $1 million or more sitting in registered accounts. Mark and Lisa have $180,000. For a couple at that level, the opposite move works better. Instead of avoiding withdrawals, they take a smaller, deliberate one every year, sized to fill up their basic personal amount, and stay inside the lowest tax bracket. Filling the low bracket protects, rather than triggers, their GIS and OAS eligibility later. Why does leaving it alone actually cost more? Every dollar the RRSP grows to is a dollar that is fully taxable the moment it comes out, at whatever rate you happen to be in that year. The government does not care whether that year is 63 or 81. Wait until 71, and the forced withdrawal amount is calculated as a percentage of a much larger balance, landing on top of CPP and OAS income you are already receiving. The invisible cost of doing nothing is not a fee you can see on a statement. It is years of paying tax at a higher bracket than you had to, on money that could have moved into a tax-free account a decade earlier. Think about it the way you would a property tax bill you know is coming every year. You would not ignore it and hope it disappears. You would plan for it. Maybe set a little aside every month instead of scrambling to cover it all at once. An RRSP works the same way. The tax bill on that money is coming no matter what you do. The only real choice is whether you spread it out on your own schedule, in years when your income is lower, or let the government hand you the whole thing at once in your 70s. I used to look at my own RRSP and feel like I had fallen for a trick. The refund felt good every April, but the tax bill waiting at the other end felt inevitable, like there was no way around it. I was wrong about that. There is a legal, fairly boring paperwork step that changes the whole outcome, and almost nobody walks people through it. Picture the difference in real terms. If Mark and Lisa do nothing, they retire with a large RRSP, a shrinking OAS check, and a tax bill their kids eventually help settle out of the estate. If they take the smaller planned withdrawal every year instead, that money moves into a TFSA, grows tax-free from then on, and their OAS stays intact. Same $180,000 starting point. Two very different retirements. But this only works cleanly if you have room to move that money somewhere useful. What if you are still working part-time and pushing your income higher some years? What if your TFSA is already maxed out? That is exactly where most people get stuck, and it is exactly what we are fixing next. This is the part of the Income Tax Act that changes everything for Mark and Lisa. Section 146.3 governs how RRSPs move into RRIFs, and it does not say you have to convert the whole thing at once. You can transfer any portion of an RRSP into a RRIF at any age before you turn 71. Most Canadians never hear this, because the default path, doing nothing until the government forces your hand, is the one that requires no paperwork at all. Even people who work with a financial advisor rarely hear about it, because managing one RRIF starting at 71 is simpler for everyone than opening one early and adjusting it every year. That single detail is what flips the RRSP from a trap into a tool. The fear around RRSPs comes from the forced withdrawals waiting at 71, a number you did not pick and a formula you do not control. Open a small RRIF at 63 instead, on your own schedule, and you decide the amount and the timing every single year. The account stops being something that happens to you and becomes something you run. That shift matters most for people who never thought of themselves as the kind of person who plans this stuff out. You do not need a background in finance to run it. You need to know the rule exists, and then you need someone to walk you through the numbers once. A lot of people avoid this because they see a large chunk withheld from a RRIF withdrawal and assume that is the real cost. It usually is not the real cost. Withholding tax is just an advance the bank sends to the CRA, calculated on the size of that single withdrawal, not on your actual bracket for the year. When you file your return, if you only pulled out $20,000 spread across the two of you and stayed inside your basic personal amount, most of what was withheld comes back as a refund. The number on the statement that lands in the mail is not the number that matters. There is also a quieter reason to move now instead of later. Statistics Canada data shows life expectancy at 65 has climbed by more than a year since 2008, and that matters here, because every extra year you are alive is another year that forced RRIF withdrawal has to stretch across a growing balance. Combine a longer retirement with modest market growth, and the years you spend paying a higher tax rate than you need to add up faster than most people expect. Waiting costs you the exact years, your early 60s to early 70s, when you likely have the most room in the lowest tax bracket you will ever see again. Let's put real numbers on it. Mark and Lisa withdraw $20,000 a year from their RRSPs starting at 63, using the room left in their basic personal amount and the lowest tax bracket. Their combined tax on that withdrawal lands somewhere close to $700 for the year, not the thousands they would eventually owe waiting until 71. Almost all the rest moves straight into a TFSA, where it grows without ever being taxed again. Do that consistently from 63 to 71, and by the time the government would have forced their hand anyway, they have preserved close to $48,000 in combined taxes and OAS that would otherwise have quietly disappeared. Compare that to the do-nothing path. Forced withdrawals start at 71, land on top of CPP and OAS already coming in, and whatever is left in the RRSP when Mark and Lisa are gone gets taxed as income on their final return, all at once, at the highest rate they ever paid. The version where they move a little every year leaves almost nothing behind for the CRA to collect at the end. That math only works cleanly, though, if you actually have somewhere to put the money once it comes out. A TFSA with room to spare is the easy case. Fewer people talk about what happens when your TFSA is already maxed, Or when you are still bringing in a paycheck and adding this withdrawal on top pushes you into a bracket you were trying to avoid in the first place. That is exactly the wall a lot of disciplined savers hit, and it is what we are solving next. The strategy adjusts depending on which one of these three situations actually describes you. If you are like Mark and Lisa, with combined RRSPs under $200,000 and a TFSA that still has room, the move is straightforward. Open a small RRIF now and set an annual withdrawal that fills up your basic personal amount and stays inside the lowest tax bracket, roughly $20,000 a year for a couple in their situation. Ask your bank to withhold based on that plan rather than the default rate, so you are not waiting until tax season to see most of it back. Whatever is left after tax moves straight into the TFSA and grows there, untouched by the CRA for good. If your RRSPs are well over $200,000, or you are still working and bringing in a full paycheck, filling the lowest bracket barely makes a dent. In that case, the withdrawals still happen every year, sized to your current bracket rather than the lowest one, and the after-tax amount that will not fit in a TFSA goes into a regular, non-registered account instead. Money in that kind of account is taxed on growth as capital gains when you eventually sell, and only half of a capital gain counts as taxable income. Paying tax at your rate today on a portion of it usually beats paying a higher rate later on the whole thing. If your TFSA is already maxed out, the approach looks a lot like the first scenario, except the leftover money lands in that same non-registered account instead of a TFSA. You are not avoiding tax completely here. You are choosing when you pay it, and at what rate, instead of leaving that decision to whichever bracket you happen to land in the year you turn 71. This is where a lot of people planning this on their own trip themselves up without realizing it. They take the RRIF withdrawal early in the year, right after CPP and OAS payments start landing every month, which pushes their income for the whole year into a higher bracket than it needed to be. The better move is waiting until December, once you can see exactly how much room is left in your bracket for that year, and pulling the withdrawal then. Same amount of money, same account, meaningfully less tax, just because of when you press the button. It helps to think through what happens if the market drops right after you start this. Say markets fall 20% the year after Mark and Lisa begin their withdrawals. Someone who has not planned this out tends to panic, stop the withdrawals, and sit on the sidelines out of fear, missing the low tax bracket window in the process. Someone who has already been doing the small planned withdrawals is in a different spot. Their RRIF balance is smaller, so the amount they are required to pull out shrinks with it, and they already have money sitting safely in a TFSA they can lean on without touching anything that just lost value. Having already moved some of the money is what gives you the choice to wait out a bad year instead of being forced to sell into one. I remember sitting at my own kitchen table with a yellow notepad, trying to find the catch. It felt too simple for something the government allows. There was not one. The math just works. If you are willing to do the small amount of paperwork most people skip. If this is starting to make sense for your own numbers, this is the moment to subscribe. This is exactly the kind of strategy built for the middle-class Canadian retiree, not just the people who already have $1 million sitting in an account. If you have read this far and still have not opened anything or called anyone, that is not laziness. Our brains are wired to treat doing nothing as the safe choice, and the government's default setting reinforces that. Leave your RRSP alone until 71, and nothing happens on your end. Open a RRIF early and choose your own withdrawal, and it feels like you are creating a tax bill out of nothing, even though the math says the opposite is true. You are not failing here. The entire system nudges you towards staying still. I've watched people put this off for years, not because the math confused them, but because doing nothing felt safer than picking up the phone, Even a financial advisor working in good faith might not bring this up first, simply because managing one account starting at 71 is easier to administer than adjusting several accounts every year starting at 63. The path of least resistance was never designed with your best outcome in mind. It was designed to be easy to manage. The shift that actually helps is small. Stop thinking of that early RRIF withdrawal as a tax event you are creating. Think of it as a trade you are choosing on purpose, paying a smaller amount now instead of a much larger amount later, on money that was always going to be taxed eventually. You are not avoiding tax. You are picking the year and the rate. You do not need to commit to a decade of withdrawals to know if this fits your life. Take 1 year. Pull out one planned withdrawal, sized to your bracket, and watch how it actually plays out on your return next spring. Seeing the real number on paper tends to do more to settle the nerves than any amount of math on a screen. Here is what this comes down to for Mark and Lisa, and probably for you too. The RRSP was never really the trap. The trap is letting the government pick your timeline instead of picking it yourself. A small RRIF, opened in your early 60s instead of forced on you at 71, protects your OAS, shrinks the tax bill your family would otherwise inherit, and replaces a decade of wondering with a plan you actually understand. This channel exists to hand Canadians specific, workable moves like this one, not vague advice you have heard 100 times before. If you want more of this kind of Canadian-specific, math-backed planning for the retirement you are actually building, subscribe.